Hi friends, Simit here from informedtrades.com. In this video, I want to talk a little bit about a book I recently read, Michael Pento's The Coming Bond Market Collapse in the United States. You can see basically the book is available on Amazon.com right now. There's the cover of the book, The Coming Bond Market Collapse in the US. Basically wanted to talk a little bit about my take on the book, what I learned from it, and sort of provide a little summary. Basically, it's a lot of his introduction to Austrian economics. That's sort of, if you're completely unfamiliar with Austrian economics, this is a great introduction. Personally, I like, it's similar to some of Peter Schiff's books, Crash Proof 2.0, How Economy Grows and Why It Collapses. It's similar in that it explains Austrian economics in a pretty intuitive and straightforward manner. So if you're new to the subject, you'll definitely, may appreciate that. I thought it was a good introduction. At the same time, if you already know a lot of about Austrian economics, I've pretty much read many of these books before. We have a whole bunch of information on informed trades. A lot of it might seem a little redundant or stuff that you already know. In terms of the core of the book is, Pento's thesis that there's going to be a collapse in the U.S. Treasury bond market, or that right now it's in a bubble, and we're going to see a mass exodus of capital from the U.S. Treasury bond market within about 4 years. So he's looking for, by the end of 2016, the expectation is that the bond market capital will have, moved out, bond prices will have dropped, yields will have risen, and there'll be a pretty different situation in the U.S. There are some key points that I wanted to highlight that the book discusses in terms of what leads to a sovereign debt crisis. One is inflation risk, which is basically currency debasement. So, part of why capital is going to flow out of the U.S. Treasury bond market from Pento's perspective is the risk the U.S. dollar is in. Right now, the U.S. dollar is running a trade deficit and a budget deficit. So the U.S. economy is importing more than is exporting, and the U.S. government, the federal government, is spending more than is taking in through taxes. These two conditions tend to put a lot of pressure on the U.S. dollar, or on any currency that is running a twin deficit is going to have some pressure being put on it, and that has resulted in the U.S. dollar declining in value over the past 15 years. And the expectation, at least from Pento's perspective, is that this will continue. Related to this is credit risk. The U.S.'s credit rating from S&P and Moody's and Fitch and major credit ratings out there. If U.S. bonds have a lower or suffer a credit devaluation, or the credit is lowered, that can also lead to reluctance or greater difficulty in securing investors, people who will buy U.S. Treasury bonds. They may demand a higher yield, especially when coupled with inflation. So that is what, if they demand a higher yield, then the expectation is that bond prices will fall. Of course, this viewpoint that the U.S. Treasury bond market is in a lot of trouble is something that is not new. It's been going on for a while. So timing it is definitely an issue. As I noted earlier, Pento is coming from the perspective that we're coming up on the point where there's going to be that turn where capital starts to move out. Pento also cites Japan as a precedent, right? So basically, Japan is also running a twin deficit now. They have a very high debt to GDP. Their credit rating is under pressure, and what's interesting, at least with Japan, is the currency, the Japanese yen, has declined by over 25% against the U.S. dollar. Many other currencies since Shinzo Abe took over as prime minister in, I believe it was December. Here's a chart going back to October of 2012. It's a dollar-yen chart, so you're seeing how much the dollar is appreciating versus the yen. It's gone up over 25% in just 6 months, or the yen has fallen 25% against the dollar in the past 6 months. At the same time, we're seeing, in terms of Japanese government bonds, we are now seeing yields rising. So the bond yields and prices are inversely correlated. So when you see the yields rising, the bond prices are falling. Investors are demanding a higher rate of return. So again, the yields were falling over a long period of time. In the same situation with the U.S. dollar. But the idea here is that first the currency weakens. So first, the Japanese yen started weakening. Then, as the inflation risk became more real and investors started to grow more concerned of it, the bonds started to fall in value as well. And then, related to that, bond investors started demanding a higher yield, a higher return on their bonds. So that's the basic thesis. It's still, there are a lot of people who look at Japan and say, oh, this is, not really a concern. Yields haven't risen that much. It's just a little bit. And the yen has been rallying so much that even a 25% move is not huge when you consider the yen has rallied, hundreds of percent over the past decade. So there's a lot of similarities in terms of Japan and the U.S. in this regard. So if you believe, or Pento believes, Japan is a precedent going to follow, that Japanese government bond market is going to enter into a crisis, and then the U.S. bond market has the same internal dynamics and is going to follow as well. This is something for Informed Trades members. We interviewed Trey Canepa. There's a long interview we talked about. He's a fund manager and has a fund focused on shorting Japanese government bonds. He has sort of the same perspective that the U.S., if it doesn't, engage in some drastic policy measures, is basically going to follow in the footsteps of Japan, and that Japan, the currency is weakening first, and then the bond market's going to go. So it's a pretty interesting book. The book talks quite a bit about this. If you're interested in the idea, maybe something worth picking up and checking out. Also, if you're interested in Austrian economics, it's kind of a good introduction on that topic. That's about it. If you have anything you want to add, any questions, join us at informedtrades.com. Thanks and best of luck in your trading.